In this episode, I am going to explain advanced market structure. I will break down the concepts like intermediate and long-term highs and lows, which are confusing for most traders, so let's get straight into it. And the first thing you need to understand before anything else is what a short-term high and a short-term low actually are. If you haven't watched my liquidity video yet, I highly recommend you check that out because this concept connects directly to liquidity and how the market moves. But for now, let's break it down clearly. A short-term low is simply a swing low. That means it is a low that has a higher low on both sides of it. In other words, price pushes down creates a low, and then the lows on the left and right are both higher than that point. That makes it a valid short-term low. A short-term high is the opposite. It's a swing high where the highs on both sides are lower than that high. Price pushes up, forms a peak, and then the highs on the left and right are lower. That's your short-term high. These are the basic building blocks of structure. If you cannot identify short-term highs and lows, you cannot properly understand intermediate or long-term structure. Everything builds from here. Now, once we understand short-term structure, we move to the next level, intermediate-term highs and intermediate-term lows. Looking at this section of price action, you can see multiple short-term lows forming. But here's where it gets important. When you have a short-term low that has another short-term low on the left and another short-term low on the right, that specific short-term low becomes an intermediate-term low. Why? Because it's a swing within swings. It's structure that is strong enough to be respected on a larger scale. The market attempted to push lower multiple times, and that central low stands out structurally. The same logic applies in bearish conditions. When you have a short-term high that has a short-term high on its left and another short-term high on its right, that becomes an intermediate-term high. It represents a more significant turning point within the current range. So intermediate-term structure is essentially built from clusters of short-term structure. Now there's also another type of intermediate-term high and low that you need to understand. And this is what I call a rebalanced intermediate-term high or low. This happens when price trades into a fair value gap and rebalances inefficiency. For example, price drops aggressively, leaving a fair value gap behind. Later, price trades back into that fair value gap, fills or partially rebalances it, and then reacts away with displacement. That reaction forms an intermediate-term low. The same thing applies in reverse. If price trades up into a fair value gap, rebalances that inefficiency, and then trades away strongly, that reaction forms an intermediate-term high. So now you can see that intermediate structure can be formed either through pure swing structure or through rebalancing inefficiencies in the market. Now let's move one level higher. Long-term highs and long-term lows. A long-term low is formed from a reaction off a higher time frame level. That higher time frame level could be higher time frame liquidity, a higher time frame order block, a major discount array, or any significant higher time frame point of interest. When price trades into that level and then aggressively trades away, that reaction forms your long-term low. But here's the key. We don't just randomly label it long-term. We refine it. We look inside that reaction and identify the intermediate-term low. And remember, an intermediate-term low is a short-term low with a short-term low on both sides of it. The same logic applies to long-term highs. A long-term high forms when price reacts from a higher time frame level and trades away with intent. Inside that reaction, we find the intermediate-term high, which is a short-term high with short-term highs on both sides. This is how you start reading the market fractally. Short-term structure builds intermediate-term structure. Intermediate-term structure builds long-term structure, and long-term structure defines the overall narrative and draw on liquidity. If you can properly identify all three layers, you will stop guessing and start reading the market with clarity. Now let's hop deeper into the charts and apply this in real time. So here we are in the charts, and you can see we have a discount fair value gap resting right here. Now let's see what happens when price trades into that level. Starting from the daily chart, I'm going to drop down to the hourly. so we can refine the structure and mark everything clearly. Now looking at this, you can see we form a short-term low right here. That low then gets swept, creating another short-term low. At this point, if this is going to develop into a long-term low, we need to see another short-term low form on the right side of it. And that's exactly what happens. We form another short-term low on the right, which now confirms this as our long-term low. The reaction off the higher time frame discount level is what gives it context, and the short-term lows on both sides confirm the structure. Now, if we're going to create an intermediate term low within this move, what I want to see is a sweep of a short-term low. So as we let price play out, we get that sweep. At the moment of the sweep, this is only a short-term low. It has not yet been confirmed as intermediate term structure. I'm anticipating it to become an intermediate term low if price reacts properly from this level. What do I need for confirmation? I need a short-term low to form on the right side while price continues higher. And ideally, if we're truly bullish, I don't want to see price come back and violate that swept low. Price then trades into the fair value gap, reacts, and forms another short-term low. Now this changes things. Because we have a short-term low on the left, and now one on the right, the swept low becomes an intermediate term low. At this point, if we're going to continue trading higher, I do not anticipate that intermediate term low to be violated. As price continues, we create another small short-term low here and start expanding higher. Then we form another short-term low. Eventually, this short-term low gets swept. Now again, this sweep alone only creates a short-term low. It does not automatically make it intermediate term. I need confirmation. So we wait. Once price forms a short-term low on the right side, that swept low is now confirmed as an intermediate term low. And once confirmed, I do not want to see that low violated if the bullish narrative is correct. You can see we get a bit of consolidation, another short-term low forms, and price continues to expand higher. Then we see down close candles that leave behind a fair value gap. Now watch this carefully. Price trades back down into that fair value gap, rebalances it, and reacts away. That reaction also forms an intermediate term low, not just because of swing structure, but because it rebalanced inefficiency and traded away with intent. Once again, I do not want to see that low violated if we're going to continue higher. And as you can see, price respects it and starts pushing up. So step back and look at the full picture. We had a higher time frame discount level, price reacted from it, and once we formed short-term lows on both sides, that became our long-term low. From there, each time a short-term low was swept, I anticipated it to potentially become an intermediate term low. It was only confirmed once a short-term low formed on the right side. We formed short-term lows, waited for sweeps, confirmed intermediate term lows, and as long as those intermediate term lows were not violated, the bullish structure remained intact. Later, price trades higher, comes back to rebalance a fair value gap, creates another intermediate term low through rebalancing, and then trades away again. This is how structure builds in real time. You're not predicting randomly. You're anticipating based on sweeps. You're confirming based on structure. And you're invalidated only when the intermediate term low gets violated. That's how you read narrative through price action. Let's take a look at this last example here. You can see we have a gap that price trades up into during London. During that same move, we sweep the Asia highs and then create an up-close candle in the London session. I'm going to mark that up-close candle as our order block. Now let's drop down to the 5-minute chart and watch what happens as price retraces back into that level heading into New York. As we move forward into the New York session, price trades back up into those up-close London candles. This is where I start paying very close attention to market structure. At this level, I'm looking for short-term highs to form, and eventually I want to see a long-term high develop at this higher time frame level. So let's see what happens. First, we form a short-term high. Then we form another short-term high. Now, if this is going to become a long-term high, I need to see a short-term high form on the right side of the key high. At this point, we don't get that confirmation yet. Instead, around 8:30, we create another short-term high. Now I'm watching closely. If this high is going to become our long-term high, I need to see a short-term high form on the right side of it. And there it is. We form a short-term high on the right, which confirms this as our long-term high. The reaction from the higher time frame level combined with the structure on both sides gives us that confirmation. Now that we have a long-term high, the next step is identifying an intermediate term high. To form an intermediate term high, I'm looking for a sweep of a short-term high. So I mark out the recent short-term highs and wait. We form another short-term high, but it hasn't been swept yet. I'm still waiting for that sweep to occur to potentially create an intermediate term high. Then we finally get it. Price sweeps this high and actually takes the previous high as well. At that moment, it is still just a short-term high. It only becomes intermediate term once we get confirmation. So what do I need? I need a short-term high to form on the right side of the swept high. And there we go. We form a short-term high on the right. That confirms this as our intermediate term high. Now, if my bearish narrative is correct, I would not expect price to trade back above that intermediate term high before delivering lower, specifically toward the original consolidation or the sell-side liquidity resting below. Notice what price does next. From that intermediate term high, price drops, then pulls back up into a premium, right back into those up-close London candles, and forms another short-term high. Ideally, from there, price should deliver into sell-side liquidity. And that's exactly what happens. Price drops and runs the lows. This is a perfect example of using advanced market structure in a situation that otherwise looks choppy and unclear. There weren't any clean, obvious fair value gaps to enter from. The price action wasn't particularly clean. So instead of forcing a fair value gap entry, we used structure. We identified the higher time frame level. We waited for a long-term high to form. We waited for a sweep to create an intermediate term high. We confirmed it with structure on the right. And then we anticipated delivery into sell-side liquidity. That's how advanced market structure gives you clarity when the chart isn't clean. All right, so that wraps up this example on advanced market structure. The key thing I want you to understand is this. When the chart looks choppy, when there aren't clean fair value gaps, and when price isn't giving you textbook entries, structure is what keeps you objective. Short-term builds intermediate. Intermediate builds long-term. And long-term defines the narrative. If you can learn to wait for the sweep, wait for the confirmation, and only act once structure is validated on the right side, you'll stop forcing trades and start trading with intent. Don't just watch this once and move on. Go back into your own charts. Mark out the short-term highs and lows. Track the sweeps. Identify where intermediate term structure forms. Replay sessions and study how price delivers after confirmation. That's how you actually internalize this. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone who needs to understand market structure properly. If you want to connect with me, join the Telegram and Discord. Links are in the description. And if you want to learn directly from me, check out the mentorship link below. I'll see you in the next one.